The moment everyone remembers. There's a quiet moment almost every future investor experiences, even if they don't recognize it at the time. It doesn't happen on a trading app. It doesn't come with fireworks or dramatic music. It happens late at night or early in the morning, when you open your bank account and pause for a second longer than usual. For the first time, something feels different, that there's money sitting there that doesn't already belong to someone else. Not earmarked for rent. Not waiting to disappear on groceries, fuel, or bills, just $100. Free. Untouched. Yours. And in that moment, a thought enters your mind, soft at first, almost accidental. Maybe I should invest this. That thought is powerful. Because it means you're no longer just surviving. You're thinking ahead. But almost immediately, something else shows up. Doubt. Your mind starts racing with questions that feel logical, even responsible. Is $100 even worth investing? What if I choose the wrong thing? What if the market crashes the moment I start? What if I lose it and prove to myself that I'm bad with money? Suddenly, that $100 doesn't feel like an opportunity anymore. It feels like pressure. So you hesitate. You tell yourself you'll learn more first. You'll wait until you have more money. You'll come back to this next month, or next year. And just like that, the moment passes. This exact hesitation, this pause between intention and action, has quietly stopped millions of people from ever becoming investors. Not because they weren't smart enough. Not because they didn't work hard enough. But because they waited. Here's the part no one tells beginners. The real risk isn't losing $100. The real risk is losing time. Time is the one thing investing depends on more than anything else. More than income. More than intelligence. More than perfect decisions. Time is what allows small amounts of money to turn into meaningful wealth. But when you hesitate, when you delay, when you convince yourself that you'll start someday, time keeps moving without you. Years go by. You earn more money. You get busier. Life gets louder. And that simple decision whether to invest that first $100 keeps getting pushed further into the future. Most people don't fail at investing because they make terrible choices. They fail because they never make the first one. They think more knowledge will remove the risk. They think more money will make investing easier. But in reality, waiting usually does the opposite. Because the longer you wait, the more intimidating investing becomes. The numbers look bigger. The stakes feel higher. And the fear of making a mistake grows stronger. That first $100 was manageable. The next $1,000 feels terrifying. The first step you didn't take becomes the hardest one to take later. And yet, every experienced investor remembers this exact moment. Not because of the amount but because of what it represented. It was the moment they stopped thinking only about today and started thinking about the future. The moment they chose progress over perfection. The moment they accepted that investing isn't about getting it exactly right, it's about getting started. Because here's the truth. No one starts investing feeling confident. No one starts knowing everything. And no one starts at the perfect time. They start with uncertainty. They start with small amounts. They start while still feeling afraid. And that's exactly why that first $100 matters so much. Not because it will make you rich, but because it changes how you see yourself. It turns you from someone who watches wealth being built into someone who's finally building it. Most beginners believe investing is about having more money or more knowledge. But the truth is simple. Investing is about starting early. Every year you wait doesn't just delay growth, it destroys potential. $100 invested today has more power than $1,000 invested years later, not because of luck, but because of compounding. Time is the engine. Money is just the fuel. And the longer the engine runs, the more powerful it becomes. What not to do with your first $100. When people finally decide to invest, they often make one big mistake. They chase hype, trending stocks, viral crypto coins, guaranteed moonshots. But with only $100, your goal isn't to get rich overnight. Your goal is to stay in the game. High-risk bets don't build wealth, they break confidence. And once confidence is gone, most people quit investing entirely. The smart first move most people ignore. The smartest place for your first $100 isn't exciting, and that's exactly why it works. Most beginners think investing should feel thrilling. Fast gains. Big wins. A story you can tell your friends. But real wealth rarely comes from excitement. It comes from decisions that feel almost boring in the moment but powerful over time. That's why the best first move for a new investor is something most people ignore. A broad market ETF. At its core, an ETF, short for exchange traded fund, is one simple idea. Instead of putting your money into a single company and hoping it wins, you spread your money across hundreds or even thousands of companies at once. One investment. Massive diversification. Think about the difference. When you buy a single stock, your success depends on one business making the right decisions, avoiding mistakes, and beating its competitors. That's a lot of pressure for $100. But when you buy a broad market ETF, you're not betting on one company. You're betting on progress itself. You're betting that over time, businesses will innovate, economies will grow, and the world will keep moving forward. That if one company fails, others step in. If one industry struggles, another grows. The risk is spread. The stress is reduced. That's the power beginners underestimate. A broad ETF doesn't need you to predict the future. It doesn't require constant attention. It doesn't demand perfect timing. It simply rewards patience. And that's why it works so well for a first investment. Many people think diversification is something you do later, once you have real money. But in reality, diversification is most important when your money is small. One mistake with $100 hurts confidence. One bad experience can push someone away from investing for years. A broad market ETF protects you from that. It gives you stability while you learn. It gives you growth without constant anxiety. And it lets your money start compounding quietly in the background. This isn't gambling. Gambling is chasing fast outcomes with high risk. Gambling depends on luck and emotion. This is ownership. When you invest in a broad market ETF, you become a partial owner of thousands of real businesses, companies that sell products, hire employees, build technology, and generate profit year after year. You're not trying to outsmart the market. You're participating in it, and over long periods of time, that simple decision of owning the market instead of chasing it has outperformed most complicated strategies. It may not be exciting today, but years from now, it's the decision you'll be grateful you made. Because the smartest first move isn't about excitement. It's about building a foundation strong enough to grow with you. Why this strategy wins long term. Think of investing like planting a tree. You don't plant it to collect fruit next week. You plant it so the roots grow strong. A broad ETF builds those roots. As you add more money over time, $50 here, $100 there, your portfolio doesn't just survive, it compounds, turning $100 into a system. Once this is set up, investing becomes automatic. You're no longer guessing. You're building. Your first $100 isn't about the amount, it's about the habit. Because the people who win at investing aren't smarter. They just started sooner. And the best time to start is before you feel ready. Why boring beats brilliant? Here's something most people never hear. The investments that look boring are usually the ones that make people rich. No breaking news alerts. No dramatic price swings. No adrenaline. Just quiet, consistent growth. Broad market ETFs don't make headlines, but they outperform most active investors over time. Why? Because markets reward patience, not prediction. The goal isn't to be right today. The goal is to still be invested 20 years from now. The power of small, repeated actions. Your first $100 is not a one-time decision. It's the start of a pattern. When you invest once, it feels risky. When you invest monthly, it feels normal. And when something feels normal, you stick with it. Consistency beats intensity every single time. Someone investing $100 a month steadily will often beat someone who tries to time the market with thousands. Not because they're smarter, but because they never stop.